Good morning and welcome to the Killik market update. All eyes continue to be on the election polls, and we've had some new data out this week which shows that a Conservative majority continues to be seen as the most likely option. Now, clearly election polls can be wrong, as we've seen many times in the past, but nevertheless, when this latest data came out, we did see a rise in sterling. And the reason for that is that a Conservative majority is thought to be the most positive possible outcome for sterling because it's the outcome that offers the greatest degree of certainty. Now, also in terms of the election, this week we had that interview between Andrew Neil of the BBC and Jeremy Corbyn. Now, the interview was widely regarded by the press as being a bit of a disaster, and so it's quite interesting to see that since the interview, Labour have actually also moved ahead in the polls. So I think that shows that this election perhaps really is quite unpredictable. And also looking again at Labour, we have talked quite a lot on this video in the past couple of weeks about the prospects of Labour wanting to nationalise a number of UK companies. And in fact, this week, both SSE and National Grid have announced they have set up holding companies in Luxembourg, Hong Kong and Switzerland. And they've actually moved large parts of their UK operations to those holding companies. Now, moving these operations will not prevent a Labour government from being able to nationalise these companies, but what it does do is put any future transactions subject to international investment treaties. And that means that hopefully, if nationalisation were to occur, the existing shareholders would hopefully get a fairer outcome. So that's why the companies have set up these holding companies, have moved their operations into it. They've done it to try and protect their existing shareholders from a negative outcome and from being unfairly bought out in the event of a nationalisation. So potentially good news there for shareholders, but nevertheless I do think it is a real shame that all these UK businesses are having to spend so much time and money focusing on contingency plans for both Brexit and for a Labour government, instead of focusing on what they do best, going about their normal daily business. So I think the cost of these contingency plans are really starting to add up for companies across the UK. And also this week, LVMH, or Louis Vuitton Moet Hennessy, the largest luxury company in the world, has announced that it will be acquiring Tiffany, the jewellery company, for $16.2 billion. And this is actually one of the largest ever acquisitions that has taken place in the luxury sector. Now, the acquisition has been approved by both boards. It hasn't yet been approved by shareholders, but that's not expected to be a problem, and we do expect the deal to go through in full by the middle of next year. Now, at the moment, Tiffany already has quite a sizable footprint in China and Asia. If you have a look at this chart here, you can see that over 43% of Tiffany's revenue currently comes from China and Asia. And that's probably one of the main appeals. That's probably one of the reasons why LVMH wanted to buy it. Most global companies at the moment do point to China and Asia as the region with the highest rates of growth at the moment. So it's not surprising that a company with a good footprint there already was an attractive acquisition target. And it's thought that LVMH will be wanting to invest quite heavily in Tiffany's Chinese and Asian operations in order to further promote that growth there. So this acquisition has been greeted quite positively by both Tiffany and by LVMH, so by both shareholders on both sides. So that's a situation we'll be watching closely, and we will be waiting for that transaction to go through early next year. And finally, this trade war between the US and China is still rumbling on. And this week we had a new bill signed into law in the US which could throw a potential spanner in the works. Now, this week Donald Trump signed into law the Human Rights and Democracy Act. Now, what this does is it allows the US to potentially take away special treatment that Hong Kong is given in terms of access to financial markets if the US no longer deems that Hong Kong has a sufficient amount of autonomy from mainland China. So signing this act into law is seen as an act of support for the protesters within Hong Kong. And it's expected that this will not go down particularly well with the Chinese, and therefore it could potentially slow down the progress that is being made in the negotiations over the trade war between the US and China. And this is potentially bad news in the short term for financial markets. Investors had been hoping for at least some kind of partial trade deal in the short term, because we are starting to see more and more more negative data showing that this trade war is impacting trade on a global level. In fact, this week we've had some data out from the OECD, the Organization for Economic Cooperation and Development, and that shows that global exports are continuing to fall. And in fact, it does appear that the Eurozone, which isn't directly involved in this trade war, is actually one of the regions worst affected. So no doubt all countries around the world are hoping for some kind of resolution to this trade war sooner rather than later. Now, moving on to the week ahead, fairly quiet one in terms of companies reporting, but we have got results out from 2 UK companies, DS Smith and Ferguson. That's it from us. Have a great weekend, and we'll see you next Friday.